Hey there, great conversation earlier today, and awesome to hear that you're interested in exploring what we'll call sort of a getting started policy, given what you now know about how permanent insurance works, both on a personal side and when held inside the corporation. Today, we're just going to look at what the policy looks like if you're starting something a little bit smaller. We had asked you to pick a number that you feel is, sort of almost like meaningless, might be a little bit dramatic, but more or less a number that feels fairly easy to fund to get started, in order for you to understand the process and to put you in a position where you can then prepare for some of this bigger, amount of capital, specifically that capital that is going to get sort of locked into the corporation. I say locked, meaning if you pull it out, you're going to be taxed heavily at a personal level. So I've designed it using the number 24,000 per year, or $2,000 per month was sort of the number that you had said. And I've done it a couple different ways. And I will share the illustrations to you. So up on the screen here, I'm going to share what that actually looks like here. You'll see that we have your current age, 55, utilizing your current birth date. There is the opportunity, depending on whether you want to backdate this birth date or not, that would allow you to fund 2 years worth up front and also reduce the cost of the insurance, a little bit, making you a year younger. So that's something we can explore if and when we get to that place. But in the meantime, what we've done is we've designed a policy that is going to provide you with some optional, what they call accelerator deposit option, or paid up additions in the insurance world, which is really what's going to supercharge that early high cash value that we've been discussing on the past few calls. So in this particular case, we have you listed as non-smoker. I know that you're quitting right now, so I'm going to show non-smoker, and then we'll also show smoker rates so that you can see. And remember, once you have quit for over a year, we can actually, send that to the underwriters to have that reassessed and have the rating removed, the actual smoker status removed from your policy. So definitely something to kind of work towards here. So in this particular case, you're going to see that this policy is designed, even though you're able to contribute up to $24,000, you only have to contribute just under $10,000. That's the total required premium amount here. Again, the max funding portion is what's going to accelerate that early cash value. The base plan coverage is sort of hyper-focused on the actual death benefit. So these things work together in a really helpful way. Now, when you look into the illustration further, you're going to see two sides of the table as per usual. You've seen a couple of these before. Just want to remind you, on the left side, these are guaranteed values, assuming that you only pay the minimum premium moving forward. And we're assuming that you pay that minimum premium essentially forever. That's what's being designed here. And we assume that there's no dividend being paid, because remember, the dividend is not contractually guaranteed from the insurance company. It's something that they are able to do or willing to do. And of course, this company, as well as most others here in Canada that are, have had successful participating whole life insurance products, have always paid a dividend and don't miss a dividend payment. However, that's not a guarantee. So it's always important for us to remember that. However, on the right side, we look at the assumption. So based on a specific scenario, what may happen if our dividend rates do continue at the same rate as it is currently. So we're not predicting what will happen down the road or predicting they'll go up or down. We're just assuming, let's pretend they just stayed exactly the same. In high interest rate environments, we tend to see dividend rates go up. And in low interest rate environments, we tend to see the dividend rate go down. This is actually a good thing, because remember, the main use for us while we are here on this planet is for leverage. And if we're leveraging, interest rates matter. And therefore, we want our policies to be growing in a similar fashion to what's going on in the interest rate market. All right. So when the economy is doing really well and rates are, we'll say, When the economy is doing too well, then rates start to increase. And when the economy is not doing so well, rates tend to decrease. And then, of course, there's everything in between. So that's the assumptions that we're making here. So you will actually see these values listed, remembering that the cash premiums is the assumption we're making. So you're funding this $24,000 for 15 years, and then you're not contributing anymore. The actual dividend is being used to help fund the minimum amount over the remainder of your lifetime. That's the assumptions that's being made in this table. So very important things. You'll notice your death benefit there. Again, significantly higher in year one compared to the cash value, but you'll notice that cash value is 20,000-ish when you had put in 24,000. And you'll notice that, by about year 4-ish, year 5-ish typically is when you see this quote unquote break-even point in cash value, noting that it is actually kind of growing like a compound interest curve. So you're actually going to gain more and more and more as we fund this policy. So the early years aren't sort of what we want to hyper focus on, although it's great to have access to this capital for investments like you're currently doing. This particular policy would probably be designed such that when needed, in the shorter term, you can utilize it for continuing your real estate investments, development deals, anything like that. And then eventually you can start to take the tax-free income by borrowing against cash value and actually not repaying until the death benefit is paid out and sort of wipes out that debt. So we're going to look at that a little bit more or a little bit further. So that's how the illustration works. However, what I've done is I've actually taken these and I've taken 4 illustrations and I've put them into 4 tabs in this particular spreadsheet here. And we're going to look at the same illustration you just saw. We took the same values, put them in this table, and we want to have a closer look here. So you'll notice we're funding it for the 15 years. $24,000 per year for 15 years. At age 71, you were saying you'd like to see about how much income you could start leveraging out of it. So what we're not assuming here is what you're doing in the first 15 years. My goal would be for you to continue borrowing and paying back by buying more assets as you're doing currently, right? So you are in the game of real estate. You are, right now you have a subdivision that you are helping to develop and you're involved in that and you're one of a few partners in that. So using the cash value for that purpose and with the intent to pay the cash value back before you hit that age where you want to see what sort of taking an income might look like without paying back is definitely encouraged here, right? Because that way your money's working in 2 places, not just in this one. This is going to grow like a GIC-ish in a tax-free way, whereas, of course, that money you're borrowing is going to, produce a much greater return. That's why you're doing what you're doing. So, of course, definitely do that and repay back when profits do come in, be it through cash flow or through capital gains, all right? So let's just look at that. We're ignoring what you're doing with the money in the first 15 years. We're going to look straight to the income. Starting at year 16 puts you at age 71. And in this case, you've been funding $24,000 for 15 years straight. And under our assumptions with the current dividend rates, and the way things are going. And we're going to make an assumption. We picked an interest rate, but you can play with this in the spreadsheet if you want to see what would happen if the interest rate was higher, what happens if it's lower. Totally up to you. We can't guarantee what interest rates will do in 16 years from now. If you can do that, if you can figure that out, let me know because I would love to know. I could probably make some money gambling on that, but neither here nor there. What we're going to do is we're going to start with a 5% leveraging rate. However, again, if we're in low interest rate environments, that number could be lower. If we're in high interest rate environments, that number could be higher. But remember, high interest rate environments means the dividend rate's probably going to increase over time, which would allow the policy to sort of move in tandem. So this is something to keep in mind as we perform this type of strategy. Now, what you will see is that $24,000 for 15 years, if you start pulling $30,000 and start accumulating a loan balance without paying any of the interest back, without making any payments, you're basically just going to run this loan balance up over time. You could pull $30,000 from year 16 all the way to year 40 before you sort of run out of money. We're going to say somewhere in this neighborhood here, around when you're like 93 to 95, you're going to start running into problems, meaning you're actually going to run out of cash value to leverage against. And the death benefit is not going to be large enough to pay off that loan as well. So we're looking at that as like a worst case scenario. So my goal would always be to go with a little less than that number. And also you'd be monitoring this along the way. So we help our clients so that, as you go year after year after year, we actually like help you to analyze this to try to figure out, hey, should we adjust up? Should we adjust down? Of course, as we mentioned before, you're not going to pull $30,000 blindly, like a pension, right? People that have pensions, they take the same amount every year regardless. Note that this is $30,000 and you're not paying income tax on it. So that's a great thing. But also, if you don't need $30,000 in a given year, you're not going to take $30,000. Maybe in some years you might need $50,000. You could take $50,000. But we just need to actually do those things, and then we need to see how it impacts the result. So right now we're looking as if it was consistent, but life is probably not going to be consistent. And again, you're not going to start pulling money from this if you don't need it in any particular given year. So that's something to note. Now, when we look on the smoker side, we could do the same thing. You're going to notice what changes when a smoker status happens here. Now, it's not as quote unquote bad as some people might think. The cost of the insurance actually goes up a little, which means you're actually, for the same amount you're contributing, you're going to get less initial death benefit. I want you to look at the death benefit column here, $327,000 of death benefit in year one by putting $24,000 in as a non-smoker. If you are a smoker, your death benefit starts at $267,000. So that's a significant difference in death benefit. But what you're going to notice is that actually your cash value isn't impacted as maybe dramatically as you might think, which is a good thing because our main focus here is cash value. It actually isn't death benefit. That's not why we were on a call today. So that's a good thing, even though you're smoking. Now, I want to encourage you to quit. And I want to encourage you that once you have quit and you've done it for 12 months, that we actually go back to the insurer and we actually get that rating removed and we work to get you the best options moving forward. Might be a great motivator, but I also want you to note that it's not a reason to not start now. In a way, I would almost argue two reasons you want to start now is that you are your current age now. And the other thing is that who knows what might happen later? Will you become completely uninsurable because of who knows what down the road? So I would say get started and use that as motivation to quit so that you're not prolonging this, right? And turning it into, hey, maybe you only quit 5 years from now. Well, now you're 5 years older. And that's going to have a negative impact on your death benefit and all of those things. The cost of insurance will go up. So I would say, even if you're smoking, this is something worth starting and use this as motivation to get that 1 year non-smoker status under your belt so that we can go back to the insurer and have them reassess. All right. At this point, so you can see the impact is not that dramatic. It does impact, though, over time. You're going to see that when we compare taking about $30,000 as a non-smoker starting at age 71. Here, you're taking about $24,000 to get you to about the same place, which gets you somewhere into the mid-90s before running out of money. So again, if you kept smoking, then yeah, like that is going to have an impact. It's almost like this, your smoker status essentially is compounding against you year after year after year, that you're getting a little less, a little less, a little less compared to all of the years that you are a non-smoker. So of course, motivation to completely quit and utilize this to your benefit, but still can make sense from a financial planning perspective, given the fact that you can leverage against your cash flow or your cash value in the early years to continue doing what you're doing anyway, which is buying more assets, selling assets, and then rinse and repeat. So that would be something I want you to consider. Now, because you had picked $24,000 as sort of that quote unquote easy number that, you wouldn't lose sleep over, I also wanted to run the scenario of what does it look like if your minimum premium amount is at about 24,000. And in order to keep that, also what that does is it opens the door to be able to fund more than 24,000 when that time comes, because it is coming for you, right? You have a lot of, assets inside the corporation. You have some capital dividend account credits that are going to come into your personal pocket, and you have a lot of things going on. But while capital is always going in and going out, you're going to need a place for that capital to reside. So this is a great opportunity here. If you go, well, hey, listen, if I'm comfortable with $24,000 minimum, that opens the door for you to be able to fund up to $60,000 maximum, which I would argue, knowing what I know about you and your assets and how you've been as an investor, as well as continuing to work in your business as a realtor, you could potentially be able to leverage or to be able to dump in larger sums of cash if you chose. So again, you don't have to do more than 24. In this case, it's 24,600 per year. I just wanted to keep the maximum number up to $60,000, a nice, easy round number. And what you'll see is obviously a much more dramatic result by doing something like this, where, hey, if I can max fund 60,000 for 15 years, what you're going to notice is obviously by the end of that 15th year, you're going to see your cash value put in about 900,000 over those 15 years. It's worth about 1.2 million, a little more than that as cash value. Your death benefit's 2.1 million. And you'll see that you can, it looks like pretty conservatively start pulling about $65,000, again, tax-free income at a personal level, under the assumptions that we've been using in this spreadsheet. And you'll make it till your late 90s before running into any problems if you were to consistently pull the 65,000 for how many years is that? It looks like about 30 years straight of doing that. So it's almost like a pension replacement. So there is that. Now on the smoker side, of course, that's going to reduce things a little bit. It's also, if we want to keep that minimum to just over 24,000, like we had shown, to make sure that, you're within your means, you're within your comfort level, it only opens the door to 54,000. So in the non-smoker status, you could fund up to 60,000. In the smoker status, by keeping that minimum at about $24,000 range, your maximum is now reduced to about 54,000. So you've contributed less as a smoker, assuming you don't quit, and you've got 810,000 contributed in this scenario over 15 years. But it'll, of course, obviously reduce your income as well. So you've been contributing 54. That's going to give you about 48 to make it to your late 90s, 48,000 of tax-free income over those 30 years. But again, you've contributed about 100,000 or $90,000 less over that time period. And of course, this is just here to give you an example of what's possible. So I've shown you some scenarios where we're using 24,000, that comfort number per year as your maximum. I've shown a couple examples where we've used $24,000, that comfort number as your minimum. The real question becomes is like, maybe you want to do something in between here, right? Maybe you want your minimum to be, somewhere between the, 10,000 that we saw in the first scenario and the 24,000 in this scenario. Maybe you want to, sort of split the difference and put it somewhere at like 14,000 and see what sort of optional premiums can be funded in that regard as well. So no rules here. There's no right answer either. The only answer that we know is that, you've mentioned multiple times that that this is something that you do want to do. You should be doing it, but you've got a few plates spinning, we'll call it. So what I would say is go with that comfort number, and we use that as sort of our peg, that comfort number either as your minimum, as your maximum, and then somewhere in between, like picking something like that in between there so that you feel comfortable with the policy that you set up. And I'll call it the first of probably multiple policies that you're going to want to have designed for yourself as you move forward, given what I know about you as a realtor with a PREC being opened and earning active income inside that corporation, as well as all the investments that you've been doing inside your corporate structure, as well as a bunch of money at the personal level that you don't necessarily want to get locked up into an RSP or into maybe a traditional investment that's still going to require you to be taxed on the way out. So hopefully this is helpful. I will send along a few other details along with this. And of course, looking forward to hearing your questions, your wonders, and keeping the wheels turning for you so that we can help you along your personal and corporate wealth planning journey. We'll chat soon. Take care.